everyone, let's take a look at continuation patterns. First up is the triangle.
So what is a triangle pattern?
A triangle pattern shows the price action trading in a narrowing or coiling range. The pattern contains at least two highs and two lows that create the shape of a triangle when connected.
Sounds pretty straightforward.
There are three different types of triangles: ascending, descending and symmetrical. All three are continuation patterns in the right circumstances.
Okay, so what are the differences between them?
Well, let's look at ascending triangles first. So an ascending triangle is a long-term bullish or bearish formation. It is normally bullish though, so we'll describe how one of these forms. Several things need to happen. First, a bullish trend needs to exist and precede the pattern.
Okay, that's fairly easy to spot.
Second, at least two highs in price need to be reached at a horizontal. This is the same as an emerging horizontal resistance line. It's as if a really big sell order has been placed to be filled at this price, and no matter what the bulls do, they cannot push the price beyond it.
Right, so the price isn't pushed any higher.
Exactly. Third, there needs to be higher lows forming. This might already be the support in the preceding upward trend line. If this line breaks, then it's not a valid ascending triangle pattern. The pattern squeezes the price and places a time limit on its completion.
Okay, so the third thing that needs to happen is that higher lows need to be formed. Got it. It's now starting to look like a triangle.
We are nearly there. Finally, we are looking for the breakout above the upper resistance level to confirm the pattern.
And it's a continuation pattern, so we'd anticipate the price continuing on in an upward trend.
Yes, but only if the breakout higher has been confirmed.
At the start, you mentioned a bearish version.
Yes, this is when the preceding trend is down, the pattern forms and the price break below support instead of above resistance. Like I said before, these are fairly rare, but they do happen.
Thanks. Can you show us how traders would trade a bullish ascending triangle, please?
Of course, let's take a look.
Okay, so now that we know how to identify an ascending triangle, how do traders trade them exactly?
Well, if traders see one of these patterns developing, the first thing they must do is to wait for it to be confirmed with the breakout. If it doesn't do that, then it's not an ascending triangle. I cannot stress this enough. Lots of traders trade a pattern assuming it will finish completing. Don't fall into this trap.
Yes, that's understood. We wait for it to break the resistance.
Once the pattern is confirmed, the next step is to assess how significant a pattern it is.
Why do traders need to assess how significant it is?
Well, traders do this to give it more or less weight in their analysis. If you think back to our previous lesson, where we've spoken about duration, this is how long it takes to form. If we are trading in a daily time frame and it forms over 6 months, that's a decent amount of time. If it's a couple of weeks, it's still a continuation pattern, just not a significant one.
Yes, I remember. The longer the period, the more weight traders give the pattern.
That's right. It's the same with the height and volatility of the pattern. If we see the Bollinger Bands widening as the pattern forms, we know there is increased volatility. This adds weight to traders' convictions around the previous trend continuing.
I see. So if traders spot an ascending triangle that is long in duration, volatility has increased and it's broken the resistance, what then?
Traders can use patterns to set potential price targets once it confirms. Traders use two methods. The first one measures the widest vertical distance of the triangle. This is normally where it starts, and the same distance is then applied to the breakout. The second method applies the parallel support trend line to the high of the triangle in the direction of the breakout.
Why do traders set a price target? What's this for?
We'd of course be using other technical analysis techniques to verify the probabilities were in our favor before placing a trade. But by plotting a price target, traders know where they might exit the trade. Remember, these are well-established patterns and other traders will have noticed and traded the pattern. They might be looking to exit when the price target is hit.
In the introduction, you mentioned traders use patterns for risk management. How do they do that?
When trading a bullish ascending triangle pattern, traders typically set their stop loss order below the support line.
Oh, I see. That's useful. That's good. Using a pattern gives a trader a price target and the stop loss area.
Okay, let's show you an ascending triangle on a weekly chart of dollar-yen. We can see the resistance line develop here. There is an uptrend into the pattern. It consolidates and we see several touches on the up-sloping support line.
And when is the pattern confirmed?
When the price breaks above the resistance line, when it's confirmed, traders might set a price target by taking where the triangle was at its widest and projecting above.
But it didn't go on and hit that price target, did it?
No, it nearly did. This one was not a successful continuation pattern. Remember, there are no certainties in trading. It would have been important to set a stop loss. In this case, it would probably be placed below the support line here.
Okay, I understand. That was handy seeing it on a chart.
Let's move on to descending triangles. Okay, next up, let's look at descending triangles.
Are they the opposite of ascending triangles?
Yes, it is nearly the inverse of an ascending triangle. It is mostly a long-term bearish continuation pattern forming in downtrends. Occasionally it's bullish and forms in uptrends, but that's rare. A lot of what we've just covered with ascending triangles is true, but in reverse.
I knew it.
Okay, so how are descending triangles formed?
Well, in order for a bearish descending triangle to form, 4 things need to happen. First, there needs to be a downtrend. Second, there needs to be a similar horizontal line forming on at least 2 lows, but this time it will be a support line. Third, there needs to be an upper resistance line that descends on lower highs. The pattern squeezes the price and places a time limit on its completion.
Got it. Thanks for explaining. And what's the fourth thing?
Confirmation, confirmation, confirmation. The price must break below the support level.
Yes, okay, I understand. Is there a bullish descending triangle?
Yes, but it's again rare. The preceding trend is up and the bullish pattern is confirmed when the price breaks the upper resistance. Let's look at how traders trade the more common bearish pattern.
Okay, so how would a trader trade descending triangles then? First they wait for the support line to break to confirm the pattern, but then what?
A trader establishes how significant it is. If it's long in duration and volatile, then it's a more significant pattern.
Correct again. It's not essential for the volatility to increase for it to be valid. Just if it does, then it adds weight to our analysis. When those elements are confirmed, traders can do what they did with ascending triangles and work out a price target for a take profit level.
That's either where the pattern is at the widest part of the triangle or a parallel trend line from the low point, right?
Spot on.
And would a trader set their stop loss above the upper resistance line?
It would be a logical place too. Yes, well done. Let's show you a descending triangle on a chart of Euro-Yen in a daily time frame. We can see here a support level develops. The price touches it on 3 of 4 occasions. The resistance line slopes down and joins this first high with 2 others. Let's zoom in a little. We can see the price broke below the support line but returned. A few periods later, the price broke below support again.
How would a trader set price targets and a stop loss for this pattern?
Well, the price target is set by taking the distance here and projecting it down from the breakout. It would be logical for a trader to set their stop loss above the upper resistance line. If the price returns to the stop loss level, then it's not the continuation pattern traders expected, and they would likely want to exit the trade.
The price later returned to test the resistance again and then dropped like a stone. That's some fall.
Yes, that was the day after the Brexit referendum. Traders trading this descending triangle in the way described would have been on the right side of that move. Next up, we are looking at symmetrical triangles.
Okay, we know what ascending and descending triangles are, but what are symmetrical triangles then?
The symmetrical triangle usually forms during a trend as a long-term continuation pattern. Depending on the initial direction of the trend, it can be either bullish or bearish.
So how exactly do symmetrical triangles form?
Like all these patterns, we need the market to be trending initially.
Okay, that's clear.
Like ascending and descending triangles, we have support and resistance lines drawn from at least 2 lows and 2 highs converging. The difference with the symmetrical triangle is that the highs are getting lower and the lows are getting higher. The 2 lines are coming together symmetrically.
And like the other 2 triangle patterns, does the price break through the, is it the support or resistance line?
It depends on the direction of the trend into the pattern. If it's uptrending and it's a continuation, the pattern is confirmed when the price breaks the upper resistance line. If there is a prevailing bearish trend into the pattern, then it's confirmed if the price breaks support.
Duration and volatility help add to the significance of the pattern.
Yes, you're right, they do. The longer and more volatile the pattern, the better. It means the bulls and bears are having a real struggle. With this pattern, there is another aspect we look at, and that is how far into the pattern the breakout occurs.
What do you mean, how far into the pattern?
Well, once we know the support and resistance launch, we know when they meet. We also know when they start. The most reliable continuation breakouts in a symmetrical triangle occurs about halfway to 3/4 of the way along the line from the first low to where the lines meet. So in this triangle, that's about here. If we see a break before or after, we give the pattern less weight.
Do they have price targets?
They do. These again can be made by taking the widest point of the triangle and projecting it from where the breakout occurred. Alternatively, traders can project a parallel trend line from either the high or low, depending on whether it's bullish or bearish.
I see. Both these methods make sense.
There is one final point to make. These patterns are normally continuation patterns, but occasionally they act as reversal patterns.
Wait, a reversal pattern as well? That's a bit confusing. How would we tell the difference?
I must stress, a symmetrical triangle as a reversal pattern is rare. However, we do need to be on alert for when the incorrect line breaks and it's confirmed. This element determines the direction of the breakout and can only be determined after the breakout has occurred. It sounds obvious enough, but attempting to guess the direction of the breakout can be dangerous.
I've been meaning to ask how we actually confirm the breakout. Is it just simply when the price passes through the level?
Well, for a breakout to be considered valid, it should be on a closing price basis. It can be supported by a candlestick pattern, like a Mirabuzu, in the direction of the continuation. The price can return to the level it's just broken, and it can then act as support or resistance, depending on whether it's a bullish or bearish break. That's a confirmed breakout, and that's when a trader might trade the pattern. Okay, let's show you a symmetrical triangle on a chart. If we open up dollar-yen in a daily time frame, you can see I've placed support and resistance lines connecting lower highs and higher lows. This symmetrical triangle was confirmed here when it broke the resistance line. This pattern formed over 3 or 4 months.
Yes, that's a clear symmetrical triangle. And what about the price target?
Well, using the first method, if a trader measures the height of the triangle here and applies that distance above the breakout, they get a price target of about 108.3. The second method takes the angle of the support line and projects that up from the highest high. This way gives traders a slightly more dynamic price target.
I see neither of those price targets got hit. Where would a trader have placed their stop loss?
A stop loss is safely set here, below the support line upon trade entry. But be patient. If we open the chart out, we can see both price targets eventually got hit and the price never got anywhere near triggering the stop loss. This upward trend continued. That's it for triangles. Next, we are looking at pennants and flags.
Interesting terms, pennants and flags. What do they mean exactly?
Pennants and flags are short-term continuation patterns that mark a small consolidation before the previous move resumes. They can therefore be bullish or bearish, depending on the trend's initial direction.
Right, so how would we identify these patterns then?
Well, they are usually preceded by a sharp trend, either an advance or decline, and they can mark a midpoint of the move.
Can you go through how they form?
So, it's important to understand pennants are shorter time frame patterns, and they usually indicate a short-term pause in a price action before it resumes in the direction of a prevailing trend. The 3 triangles we looked at earlier in the lesson are longer-term patterns. Pennants are shorter term. If analyzing in a daily time frame, they can last anything from a few days to a few weeks.
Okay, and when would pennants form then?
So we've just mentioned pennants usually appear after a significant spike up or down in price. That's the first thing to check.
And what do they look like?
A pennant forms a small triangular, cone-like shape that begins wide and converges as the pattern matures. These are too short-term to be confused with a triangle pattern.
Sounds pretty easy to identify.
Usually they are, but sometimes there won't be clear highs and lows from which to draw and confirm the trend lines, in which case the price action should just be contained within the converging support and resistance lines.
Right, and so I'd imagine that if the lines are converging, this would also provide us with an indication as to how long the pattern will last for?
That's exactly right. Because they are converging, this places a time limit on the pattern's creation. For a bullish pennant, a break above resistance signals its confirmation and that the previous advance has resumed. For a bearish pennant, a break below the support is confirmation that the previous decline has resumed. Now, Let's look at how flags are formed. A flag pattern is very similar to a pennant. It broadly has the same characteristics. It is preceded by a sharp move, it is short in duration, and is a pause in the trend. The price also breaks above the resistance in a bullish flag and below the support in a bearish one. The only difference is that they have different shapes.
I'm with you so far. How are their shapes different?
Well, a flag is when the price develops a sideways channeling range with parallel support and resistance lines. If the previous move was up, then the flag would normally slope down. If the move was down, then the flag would normally slope up.
Got it.
Because flags are usually too short in duration to actually have significant highs and lows, the price action just needs to be contained within two parallel trend lines.
That makes sense. Thanks for explaining.
A breakout above a resistance trend line in an uptrend or a break below a support trend line in a downtrend signals a confirmation and the resumption of the prevailing trend.
So a breakout signals that a trend is resuming?
Yes, let's look at how traders trade them. Okay, now we are going to look at how some traders trade pennants and flags once confirmed. Both are traded in the same way, with traders using them to confirm the continuation of a trend. One term traders use when trading pennants and flags is the flagpole.
And what does the flagpole mean?
In a bullish continuation of either pattern, the flagpole is the height of the short, sharp trend up we mentioned earlier. It is the vertical distance from the start of the initial trend. This is normally from the previous resistance line up to the start of the upper resistance line in the pattern. It's the other way around for a bearish pennant or flag.
I get it. And I guess it would look a bit like a flagpole on a chart.
Yes, it does. When the pattern is confirmed, traders use the length of the flagpole to project from the breakout as a price target.
Okay, that's good to know. Thanks.
Traders can set their limit orders at these extended levels. Projected price extension levels become more significant if they get multiple confirmations by additional support and resistance, horizontal trend lines, previous highs or lows, Fibonacci retracements or extensions, moving averages, and so on. If a trade is initiated, stop losses can be set below the support line for either bullish pattern. Let's find some on a chart. If we pull up a daily chart of dollar yen, again we can see a classic bearish flag and bullish pennant. Let's look at the bearish flag first. Let me draw in support and resistance so you can see what I'm talking about. It formed after a short, sharp downtrend. This one was particularly fast. There are a couple of touches on both the support and resistance lines before the price breaks lower, and it's confirmed as a continuation pattern.
And the pennant?
That forms over here. Again, let me add support and resistance lines. You can see the prior uptrend. The price is coming together before breaking through resistance and continuing. Let's zoom in a bit. We can see the day after it breaks, the price returns to resistance and retests it as support. This helps traders confirm it as a breakout.
And what about price targets for these patterns?
Let's look at the flagpole. In a bearish pattern like this, it's drawn from where the sharp trend into the pattern broke its support. This is here, down to the low of the pennant. Traders can take that length and project it down from where the support of the pennant was broken. It's logical for traders to set their stop loss here. This would have been triggered in this potential trade. The price didn't make it down to the limit level and would have retraced and triggered the stop loss a month or so later.
Probabilities, not certainties, right?
Yes, there are not many certainties in trading. If a trader was trading the pennant, they would follow a similar process.
So, what is a cup and handle then? It's a strange term.
The cup and handle is a bullish continuation pattern where an upward trend has paused but continues when the pattern is confirmed. As the name implies, there are two parts to the pattern, the cup and the handle. These patterns are fairly long-term in nature. In a daily time frame, they can take between 2 and 6 months to form.
Okay, and what are these two parts exactly?
Let's look at them in more detail. So the cup forms after an advance. We all know by now there must be a trend to continue. An existing bullish trend must be well established before it forms. It looks like a ball or rounding bottom, hence the name.
Ah, it all becomes clear.
The cup should be U-shaped. A V-shaped bottom would be considered too sharp of a reversal to qualify. The softer U shape ensures that the cup is a consolidation pattern with valid support at the bottom of the U. The perfect pattern would have equal highs on both sides of the cup, but this is not always the case.
That's fairly subjective. Can you give an example of a U shape?
I appreciate that there are no set rules for what a V or a U shape is. I'd say one like this is probably a V, but this one is probably just a U. Again, the easier it is to spot, the more weight we give it. As the cup is completed, a trading range develops on the right-hand side, and the handle is formed that resembles a flag or pennant pattern.
Right, so the handle looks like a flag or pennant. Got it. And what does the handle signify then?
The handle represents the final consolidation before the big breakout and can retrace up to a third of the cup's advance, but usually not anymore. The smaller the retracement, the more bullish the formation and significant the breakout. For an aggressive trader, a subsequent breakout above the handle's trading range signals the confirmation. A conservative trader might wait until the resistance formed at the top of the cup was breached to confirm the pattern. Finally, let's look at how traders use the cup and handle once it's confirmed. Previous resistance levels reverse to be support after breakouts, and the price action sometimes retests them, which could be an additional opportunity to trade.
That makes sense. Can traders set a price target for this pattern?
Yes, the projected price target after a breakout can be estimated by measuring the distance from the right peak of the cup to the bottom of the cup.
Is that then projected up from where the pattern broke out?
You're learning quickly. Yes, apply the distance up from the breakout and that's the target price. A logical place for a trader to place their stop loss would be below the resistance line formed by the handle. Shall we take a look at one on a chart? Let's show you a classic cup and handle on an hourly chart of WTI crude.
Hourly? I thought these patterns went on for months.
We haven't really discussed time frames yet. This is a really important part of trading and we'll expand on it in the final module of the course. For now, you need to understand these patterns can form in various time frames. We've been finding them in a daily or weekly time frame so far, but even if a trader has a shorter outlook, these patterns are all still useful.
Okay, patterns aren't set to long-term time frames. Got it.
First, note the upward trend into the cup. The U-shaped cup formed here. This is the upper resistance line of the cup, which also forms the resistance line of the handle. It's not completely horizontal, but that's okay. We can see the support line of the handle forms here. The handle is fairly shallow, only retracing about 1/3 of the depth of the cup.
The shallower the handle, the more explosive we'd expect the breakout to be, right?
Yes, the price breaks resistance here, retests the old resistance line, this time as support, and continues. You're going to ask me about price targets and stop losses now?
Yep. How would these have been set?
The price target is the depth of the cup projected from the breakout. We can see the price later consolidated at this level, which shows that orders were likely being filled here. On a cup and handle, the stop loss is set below the handle's support line, about here.
In this lesson, we've looked at 6 continuation patterns. We've been introduced to ascending and descending triangles. Both can be bullish or bearish long-term continuation patterns.
Symmetrical triangles can be bullish if preceded by an uptrend and bearish if preceded by a downtrend. Each pattern is only confirmed when there is a breakout in the direction of the trend. If that doesn't occur, then the pattern is not valid, which means there's no evidence of a continuation.
Traders trade these patterns by using price targets. For triangles, these can be worked out in 2 ways. First, they can take the maximum vertical height of the triangle and project that from where the breakout occurred. Second, they can extend a parallel trend line from the high or low on the side of the breakout.
Pennants and flags are short-term patterns that require a short, sharp trend before they form. The patterns form when the market is pausing for breath before moving on.
Traders trade pennants and flags by taking the length of the flagpole and projecting it from the breakout from the pattern.
Finally, we introduce the cup and handle. This is a bullish long-term continuation pattern. This is made up of 2 parts, a U-shaped bottoming cup, followed by a pennant or flag-shaped handle. Again, this is only confirmed when the price breaks the resistance line drawn at the top of the handle if the trader is aggressive, or the cup's resistance line if conservative.
Well done, everyone. We are going to introduce a mid-module assignment next. Have a go at that, and I'll see you in reversal patterns.